Alright, so for this video I wanted to cover Section 1250 gains. So these are gains on the sale of real property that was used in a trade or business, so it was depreciated. So this video I want to cover how we can offset unrecaptured Section 1250 gains with other capital losses. So I've got a bunch of videos on Section 1250, recapture, the sale of real estate. So I'll put a bunch of links below in the description for those if you want to go watch those first. But the point I want to highlight in this video is how when we have Section 1231 gains and we have unrecaptured 1250 amounts, we can still use capital losses from other sources to offset those gains. So I've got one slide in front of us, and then we do have a tax return here for our taxpayer, John Q, which we'll be able to see how this works. So just a bit of background. Again, I encourage you to go watch the other videos first if you're new to Section 1250 or 1231. But when we have unrecaptured 1250 gains, this is a component or a piece of our 1231 amounts. So when we sell real estate, whether it was single-family homes or multifamily apartment units, commercial real estate, when it's depreciated and then we sell it, we might have some depreciation recapture. The unrecaptured Section 1250 amounts are a recapture of depreciation. It's subject to ordinary income tax rates, but it's capped at 25%, and initially it's treated as long-term capital gains. The reason why that's important, because even though it's subject to ordinary income tax rates, because it's initially treated as a long-term capital gain, that means we are allowed to offset it with other capital losses, right? If we had a pure ordinary income amount that was being recaptured, we can't offset it completely with other capital losses, right? Remember, we're limited to that $3,000 capital loss limitation per year. So when we have 1250 gains, it's really great because if we have losses from other sources, we can offset them completely. So the example we're going to be working with here, we have John Q taxpayer. He's a single filer. His W-2 income is $600K, right? And he's got $50,000 of net 1231 gain passing through on a K1 from the sale of real estate. Now, of the $50,000, the 1250 unrecaptured piece is $18,637. The remaining is just pure long-term capital gain, Section 1231 gain, right? Now, the $31,363, that long-term portion, it's going to be taxed at a 20% rate because John's in his high income tax bracket given his W-2 income. But the unrecaptured 1250 gain, $18,637, subject to ordinary income tax rates, but capped again at a maximum of 25. So here's the other little wrinkle in the fact pattern that helps John. John also sold some stocks, so he was just trading stocks in his brokerage account, and he had long-term capital losses from the stocks of $41,363. Now, because he has a long-term capital loss on these stocks, he can use that to offset the 1231 gain here, and it includes the unrecaptured 1250 amount. So the way the math is going to work here, he can apply up to $31,363 of losses against the long-term portion of 1231. So you apply that to the piece that's not the unrecaptured 1250 gain. And then the remaining 10K can be offset against the 18,637, which is the unrecaptured 1250 piece. So the way this is going to work out is John basically offsets almost all of this capital gain. The only piece that's left, there's going to be 8,637 remaining of unrecaptured 1250. That is being subjected to the maximum tax rate of 25%. All right, so let's go look at the return so we can see how these numbers actually land on the 1040. So we've got, again, John Q taxpayer here, single filing taxpayer. We look at line 1, his wages are $600,000, and he's taking the standard deduction. Now we can see here on line 7, the capital gain that's ultimately flowing through is $8,637. So if we jump down to Schedule D here, we can see Schedule D, the amount of long-term capital, the amount of 1231 gain that's treated as long-term gain flowing through is 50K, right? And then we could see up here on AB, and we'll look at the 8949 as well. This is the losses on the sale of stock. So these are separate items, right? So he's got a K1 that shows 50,000 in 1231 gains from the sale of real estate. 18,000 and change is the amount that's unrecaptured 1250. And on this line AB, we just have a straight stock sale. So if we jump down to the 8949, we just have sale of stocks. He did a grouping of them. Long-term capital loss. So the cost basis was 43,363. 2,000 in sales proceeds. So he took a real bath on this one. It wasn't good. So his net long-term capital loss on the sale of the stock is $41,363. We look at the 4797 down here. So this is the amount flowing through from the K1. That's all fine. And the piece that we're really interested in here is the Schedule D worksheet. So the Schedule D worksheet reconciles how the unrecaptured 1250 gain is taxed. So I'm not going to go through the whole Schedule D worksheet. I have separate videos on those, which I'll put below. But the important piece here to remember is if we go to page 2 of the worksheet, this is the relevant section that's important for us, right? So lines 35 through 40. This is where we report the unrecaptured 1250 gain that is subject to the maximum tax rate of 25%. So what we have here is the amount of unrecaptured 1250 gain, 8,637, that's being subjected to this maximum rate is reported here on lines 39 and 40. Notice this is not the full amount, right? Remember, the full amount per the fact pattern was 18,637 of unrecaptured 1250 gain. Because John had losses from other sources, he was able to chip away at that amount of unrecaptured 1250. So now he's only paying the 25% tax on this piece, the 8,637. Okay? So what's really, really important here to remember is that when you have unrecaptured 1250, it might not be great because we have to pay ordinary income tax rates on it up to the maximum of 25%. But because the character of the gain is still treated as long-term capital gain, right? So we have the 1231 down here, that piece, the portion of which is unrecaptured 1250. Because it's still long-term capital gain, we can use other long-term capital losses to offset those amounts. So we do that netting exercise first, which is what we've done here for John's tax return. And after the netting process is done, we are then subjecting the unrecaptured 1250 piece to whatever ordinary income tax rate is appropriate, or in this case, because John is a high income earner, his AGI and his taxable income are above those relevant thresholds. He's paying the maximum 25% tax rate on that unrecaptured 1250 piece. But again, it's still a better solution than if you had to pay full ordinary income and the full maximum marginal tax rates on those earnings. Okay, so I hope that was helpful. Again, very quick video just covering this concept, but very, very important. Remember, if you're a real estate investor, be very mindful of 1231 gains, 1250, 1245 covering personal property, recapture amounts, long-term or ordinary, all very, very important when computing what your actual tax liability is on those flow-through earnings on a yearly basis. All right, so that covers it. Thank you so much for watching. Look forward to seeing you again in the next video. Obviously, please feel free to leave a comment below. Happy to answer any questions I can, and I will see you again soon. Thank you.